Hi guys, Chris here from Acquire Wealth Solutions. Today I'm just going to give you a really quick webinar on fixed rates and whether to fix or whether not to fix. And we're going to go through the quick eternal debate of should I fix my rates or not, which is coming across everyone's lips right at the moment with the current climate that we are in at the moment. So first of all, why have fixed rates changed recently? Okay, so most banks, as you might have remembered, when the Reserve Bank was putting the rates up, they were actually putting the rates up more than what the Reserve Bank was putting them up for. The reason for that was because overseas money that they were borrowing or buying in to then lend out was actually quite expensive at the time. So it was actually very expensive compared to what it's previously been. So they had to recoup some of those costs. Now that money has eased a little bit and some of those lending costs and people are happier to lend more, especially in the Australian market because it's a good solid property market that we have here in Australia, some of those margins that the rates were charging and the banks were making a lot of money on. As you would have seen, CBA made the biggest profit they've ever made. In the billions it was. So, now they're wanting to come a little bit more competitive with that. So what they've been able to do is obviously lock in rates from where they're getting their money overseas, or by your term deposits being deposited in that bank, it gives them the flexible then to offer a fixed rate so they know they're going to get a guaranteed return and they're going to pay a guaranteed return for a client that puts their money in for that. So they've been reviewing their rates. Alright, so fixed pricing, it's impacted by long-term money markets, alright, where the rates change and most banks adjust their rates upwards or downwards depending on the market. So currently at the moment the Reserve Bank's been sitting, I think it's had the last 5 Reserve Bank meetings where it hasn't changed the bank bill or the Reserve Bank price of 4.75%. Alright, so, but there's still underlying uncertainty about what's happening out there in the current economy, especially with the US and the overseas and Europe and so forth. So they're actually thinking that rates may come down, and that's why fixed rates are one of these times where they actually, have reduced them, and they're actually cheaper than the variable rates at the moment because they're giving certainty to the bank over a period of time. So just should I fix my loans or should I not? You need to consider obviously some of the benefits, the disadvantages and the advantages of fixing your loan, what the interest rate is and what your own financial situation is. Obviously banks cannot predict whether the Reserve Bank's going to put the price of money that they buy it from up or down. They can obviously have their economists and look at what fundamental things are happening, but they're still not 100% sure going to know whether the Reserve Bank's going to put the price of money up or the price of money down. However, to reduce the interest rate uncertainty, you may consider splitting their loan or fixing a portion of the loan. Remembering you don't have to fix the whole lot of your loan, you can fix a portion of that as well. So it gives you some security to know exactly what your payments are, and the variable allows you obviously to pay more money off or to put extra money in your loan or to have features such as lines of credit or offset accounts attached to those variable portions. Alright. What's rate lock? Rate lock is really a feature that makes you, when you apply for the loan or apply for a fixed rate, it means they're locking in that current rate that you're applying for. Alright, as we've said here, usually there is a fee charged for this and it's 0.15%. Some of the banks waive this fee. Alright, others make you pay the fee. It means that you're locked in for usually up to 90 days from when you submit your application. So you're guaranteed that rate. Now, what happens if rates actually drop? Alright, you will actually get the better rate even though you've paid your locked in rate. However, if the fixed rates actually rise, because you paid your rate lock fee, you'll actually get the rate at the time that you put your application in and what time you fix that. So it's really important. So if those fixed rates did go up by 0.5%, all of a sudden you'd actually be locked in because you paid your rate lock fee at the lower amount. What are the benefits of fixing your loan? Obviously it means that it gives you more security. All right, you're going to know every month, every week, fortnight what your repayment's going to be. All right, that interest rate's fixed for a period of time. It can be anywhere from 1 year to 5 years. I think there's even some 10-year loans around as well. All right, but we tend in Australia to fix our rate for a period of 3 to 5 years. Usually a 1 year rate is usually a honeymoon rate, and it's usually a starter off. It's usually an enticing loan to try and get you in and entice you into taking up the bank's product. All right, what does it give you? It gives you peace of mind. It gives you that sleep of night factor, so you can sleep and with comfort and know exactly what your repayments are, particularly in periods of interest rate uncertainty. Obviously, we're starting to smooth out. However, previous to this, we were seeing a lot of obviously rates start increasing and going up. From when we got down to the 5% rates, we've seen things start to go up by the banks. All right. It also assists with budgeting and managing other expenses. So if you're tight on your money, or you've got a limited budget, or you want to know exactly how much it's going, or you've got a growing family, all right, and you want to know how much your loan's going to cost, it can be a really good time to fix in your loan there as well. All right. As rates are changing and so forth at the moment, there are some really great benefits around at the moment for fixing a loan. All right. We're getting in around that 6.5% for a 3-year fixed rate, which at the current situation where most variable loans are sitting at the moment, most variable rates are hovering around that 7% mark. All right, so whether or not they come down and go below the 6.5, this is what the risk factor is. However, they are looking very attractive at the moment. And if you look back at what the Australian economy usually runs on, interest rates tend to sit around that 7% mark. So if you're fixing in for below that 7%, it looks like you might be taking advantage of the market and beating the banks a little bit at their game. What are the disadvantages of fixing a loan? Obviously, the main disadvantages are, the interest rate's fixed for a period of time. So regardless of any movements in the variable rates, whether that be up or down, all right, you are locked in for that fixed rate. If you need to sell your property, move out of the property, or change something about that, obviously you're going to incur break costs. All right, break costs are the early repayment of that fixed rate, or what the bank may have made on a loss of that fixed rate through switching or discharging out of that actual loan. All right, it's also difficult sometimes to make extra payments during the fixed rate period, as they call that breaking the loan as well. Most banks allow you to pay an extra $10,000 per annum off your loan in a fixed rate period. However, each bank is a little bit different on whether they allow you to do that or not allow you to do that. So it's one real consideration to do, especially if you're thinking of getting a large pool of money in. All right, and you want to be able to pay that loan down in a great sizable chunk, or you might be selling a property. You want to condense and pay that fixed rate. You may be incurring a break cost on your loan. Now, I do have an example. I had a client that had a very large loan, a $1.2 million loan. He fixed in at the higher end of the market a couple of years ago at 8.5%. Now, when the rates dropped down to those 5%, the low sixes there, his break cost to get out of that loan cost him $120,000. Now, that was because he fixed in at that time when it looked like rates could have gone up to 9.5%, 10%. Right, so he wanted to make sure that he was secure. However, because his property was yielding a 10% yield, he knew he could afford that. Even if rates did go up or down, he wanted to know that he had the security of that repayment. Obviously now, once rates have come up, that break cost would be a whole lot more even to break out of that thing. However, if you're fixing in now at 6.5%, rates have really got to drop to 5%, before you're going to have a huge incremental break cost. However, there will be some sort of administration and break cost fee if you are breaking the term before you come out. What happens to the fixed rate loans that are currently in the pipeline? All right, if you've already rate locked your 2 to 3 year fixed rate, then you'll see the new lower carded rate applicable to your loan. So like I said previously, if you've already rate locked and you've got your application in and the rates drop, you're going to get the new cheaper rate for you. However, if you've not rate locked your fixed rate and the rate lock has expired, then the rate applicable to you will be the carded rate. So it can actually be higher if you don't pay a rate lock fee. All right, it's a little bit like gambling. You either pay the fee and then you're locked into that rate, or if it comes down, a better rate. However, if you're not locked in and paid that rate lock fee, you get the fixed rate as of the day of settlement. So where do we go from here? Obviously, everyone is different. All right, everyone has different goals, they've got different lifestyles, and they've got different things going on, and they're building different types of portfolios. So we need to work out where you are and what you're trying to achieve, what your personal goals are, what your lifestyle is. Do you have lots of surplus income? Do you have, very little surplus income? Are you looking to save for, the children's education or university or something? Do you want to know that your security, of your payments, right? Everyone is different on what they do. Sometimes when we're investing, we actually need a buffer account to cover. Now, a buffer in a fixed rate would not be a great loan because we can't access it and redraw cash out of that because it's not a flexible loan. It's not variable. All right, so that would be the wrong loan. However, if you've got a house that you're planning on keeping for 5 or 10 years as part of your portfolio, and the fixed rates really look like a good time to fix in, or now would be a perfect time to move on that. So what do you do now? Obviously contact us now for a complimentary strategy session. Right, we'll have a look in the fine details of your loans. We'll have a look and we'll find out where you want to go. We'll see which path and how we can get you onto a path of wealth creation, using fixed rates sometimes and using variable rates and others, and sometimes having a combination of both. So we've got some security and some pluses of all the variable. All right, so we like to work out a plan. All right, and sometimes a fixed rate is going to be important for you, and other times it's going to be a variable. So I hope that's given you an insight into whether or not it's a good idea to fix or it's a good idea to stay as variable. There are some great fixed rates around at the moment, and I'm actually looking at myself at going in for a 3-year fixed rate right at this point in time. However, I won't be putting all of it. I'll be splitting my eggs, so I'll be having a portion in fixed and a portion in variable. But please, if you've got any questions or you want us to have a look and go into a strategy system, please call us now on 1300 734 647 or email us at admin@acquiregroup.com.au and we'll be in contact shortly. Thanks very much. I'm Chris Pullen from Acquire Wealth Solutions, and I look forward to talking to you soon. Cheers. Bye-bye.